And let me just remind you guys that we are on a 30-second delay. I've been having some internet problems. Um, so yeah, that's hopefully just to make the stream a little more smooth. So I will see your message. If I don't read it immediately, I will see it in 30 seconds. So yeah. Yeah, Rex is here to annoy me. I don't mind if you guys annoy me, it's fine. You can be rude, but I mean, hopefully we're all here to learn and be nice to each other. So, I mean, hopefully you're being rude as a joke and it's not serious. I mean, if you're seriously being rude, then, I mean, there's just no room for that here. Okay, we'll start in a second. Move this out of the way. Math is for nerds. Okay, yeah. So, we're talking about probability spaces, right? Like a state space of things that could possibly happen, and then random variable was, some sort of function on that state space that says if a certain state occurs, like randomly, then this is the value that occurs. So like you have 6 sides on a dice. If you roll the side a certain side, it might be a 3 or a 4. So we're assigning values to different random things that could occur. So yeah, I want to sort of try to gear this towards finance a little bit. I think viewing it as money isn't necessarily the only way you can view this mathematics, but I think it's like a good motivator for a couple of reasons, which I'll probably get into eventually today. So this is lesson 19. I'll just say more on random processes. Oh, and I guess I should also mention that we still will be doing the 24-hour stream tomorrow. I don't know if I'll need some sort of delay, but I'll try to make it less than the 30 seconds today. I guess I just wanted the 30 seconds in case something happened, just in the worst case scenario. But if it seems to be working out on like a lower delay tomorrow, I'll probably have it on like 5 or 10, maybe 5, 10 seconds, 15 max, maybe. Um, no, you're good. You're good, Jeff. Yeah, no. If you're joking, it's completely fine. I just don't want any, yeah, unnecessary meanness. Is You're not gonna hurt my feelings. I just don't want, a general negative vibe in the chat. Um, Shaggy Scooby Doo. Yeah. Okay, so yeah, we're dealing with these processes. You want to think of it as, well, if it's a random stock price, usually the stock is continuously trading, so you could think it has a price at any given time. But we want to sort of simplify that situation a little bit, and we want to maybe view things instead of just simply, instead of the continuous model, let's just start with a model where things are only changing at discrete moments in time. So maybe there's like time equals 0, stock is a certain price, time equals 1, maybe it has some, it can vary, but it goes up or down at time equals 1, and then wherever it is there, it continues to go up or down from there. So I actually came up with a little kind of model example just because I think it's an interesting little interesting example. So going on along the line of thinking from the last lesson, talking about the chess tournaments. So let's say I start with $100. Kind of like last time. Well, or maybe I started with 0 last time, I can't remember. But let's say I start with $100 and I play chess tournaments like every week, let's say. And let's just say for argument's sake, I'm gambling on the chess tournaments. So if I win the tournament, I win 20 times my bet. If I come in second, I win 4 times my bet. And then if any other place, I just lose my bet. So so I have a 10% chance to win, let's say. And I'll win 20x my bet. I have a 15% chance to come in second. And then I win 4x my bet. Or 75%, I lose everything. So I guess you could say it's minus 1x. Or I win 0, I guess, depending on how you want to view this. Yeah, Sticky. Yeah, the 30-second delay is just due to my internet, so that if it like has to cut out and reconnect, then you won't notice, I guess, other than it being delayed. How much do I charge for tutoring? That's a good question. I mean, probably it would depend on the person, but just a general price, if I'm going to throw it out, it would be like $75 an hour, or if you get 5 hours together, I could bundle it for like $40 per, so it'd be $200 for 5 hours. But yeah, I mean, depending on your situation, if you're struggling more, I could give a discount for sure, depending on your exact situation. But yeah, I can tutor anything from, mostly it's like calculus people want. Calculus, linear algebra. I could do number theory, real analysis, measure theory. Yeah, just ask me about it. Do I have a bikini? What are these questions? All right, so this is the scenario I came up with. Basically, you can kind of think of it, it's similar to the binomial process, but now we have 3 options, so you could consider it a trinomial process. But this one's a little bit different because I'm allowing the amount I bet to change at each step. So the question here is that I want to pose, and maybe we won't even answer this right now, but I really want to pose the question, which is basically how much of my money should I bet each time? So, and I kind of want you guys to think about this for a second, so I'll leave this up here. But the question is, how much of my bankroll should I bet each time? All right, so I want maybe some guesses, maybe try to justify your guess a little bit. But just think about this question. So there's 3 things that happen every time I go to play a chess tournament every week. 10% chance I win it. So if I bet like $10 and I win $200. If I come in second and I bet $10, I win $40. If I come in any other place and I bet $10, I just lose my $10. Right? So let's see. Video. Yeah, I'm not sure if it's the best solution either, Jeff. I'm just trying to do something so that it doesn't, so that, people that it doesn't start buffering and people leave. But so yeah, I mean, I'll think about better solutions, but this is what we have right now. So if you accept the concept of expected value, it really doesn't matter how much I bet. Well, that's the question. Does it matter how much I bet? I think it matters. So, I mean, if this is all of my money that I have in existence, I mean, I have a 75% chance to lose it. So I probably don't want to bet it all on one tournament, right? I mean, it depends. I mean, you're bringing up a good point, though. It depends on how much other money I have first, right? And also how much I care about. If that is all of my money, the $100, then, you know, maybe I don't want to lose all of it, or maybe I don't care at all, right? Maybe I'm just a gambler and I'm gonna spend my last penny on every, you know, fun casino game I can find, and I just don't care. So it is a little bit of subjectivity, but I want to hear like some sort of justification. You know, I could just bet nothing every time, and then, you know, maybe I'm a very safe person and I just don't like to gamble at all. And betting any amount of money and losing it would be bad, right? Yeah, so the expected value is 1.6, correct. But I don't always get the expected value, right? There's a little bit of risk involved here. Yeah, if I'm counting cards, you know, that's going to change odds for sure. But you can't count cards in chess, so that's not really going to work here. Yeah, that's where I'm going, Jeff. Yeah, exactly. Utility of the money. Yeah. You may have a point. If the expected value is negative, you should never bet at all. Yeah. Unless there is technically, if the utility of your money is convex, then you just like gambling. You don't care that the expected value is negative. You just enjoy betting, basically. But you're correct. Yeah, it depends on the utility of your amount of money that you have, right? So yeah, let's look at two extremes. So in one extreme, I could just this is the $100 I need for, you know, for something really important, and I can't even lose a single penny. So even though the expected value here is positive, I can't even bet $1, because if I lose, and I'm going to lose 3 out of 4 times, that's just not acceptable to my utility of wealth function. You could think of it like that. So in that case, the optimal bet would just be to not bet at all. I just bet $0 because I can't risk anything, and I have a 3/4 chance of losing. Yeah, convex utility of money, you know, nobody's ever really going to have that, but I guess technically a gambler, you know, somebody that goes to the casino and they're expecting to lose money, they probably have a convex utility of wealth, because they don't care that their expected value is negative. They're just, you know, having fun taking the risk, essentially. So yeah, this really has to do with risk. If there's a chance to lose money, you know, the more I care about the risk, the less I'm going to want to bet. If there is some non-zero chance that I'm going to lose everything. What's interesting here is how you measure the goodness of a given strategy. Yeah, exactly. So yeah, let's kind of write down some of these ideas. So I'm going to actually say here, there's no one answer here. It depends on how much you care about this $100. If you don't care about the $100 at all and you're a billionaire's son, then you could just bet all 100 on the first tournament, and if you lose, oh well, who cares, right? Or in the other extreme, maybe you don't want to lose any money ever, and then you won't even bet $1, even though it's a positive expected value. You're not willing to risk that money. Then your optimal bet would just be 0. So basically the answer is ambiguous. It depends on how much you care about that $100, essentially. I'll leave up the odds over here just for a second. Well, actually, when I ordered DoorDash $12 order cost me delivery, but $14 is no delivery. Can we assume there exists f of x that represents how much you value the dollar? Yeah, that's exactly what we're going to get to. So, and it actually turns out that this function f that you're talking about in chat, it doesn't really matter much about the precise function that you pick. It really just matters about the concavity of the function. So yeah, let's look at two extremes. What if I bet on putting the money into a government-approved registered savings account? Yeah, well, we'll actually get to that. That's important. Yeah, so if you put your money with the government, then there's no risk at all, right? This chance of losing basically doesn't exist anymore. So yeah, if you're a person that likes to not take risk and you just want a sure return no matter what, then you would put your money with the government, because the government just prints the money and they're never gonna not pay you, right? Unless they don't exist. Which I guess theoretically could happen, but right, so the point is that, yeah, we need to write down how much we value our wealth here in terms of how much money we have. So, and again, we're talking about money here, but you could think of this as like valuing some quantity of something, right? Like some bacteria might value a certain energy state or something. So it might be putting some sort of value on some other quantity that's randomly changing, that it's, trying to acquire or something. So yeah, we'll call this a utility of wealth function. So this is just some function u of w, and some of the common ones are natural log, or another one I've seen it's common is like negative w to the negative alpha, where alpha is some number greater than or equal to like 1. Or maybe it could be greater than or equal to 0, I'm not sure. F of x would control the bets. I'm just being shown only to 250k. Yeah, only to 250k, right? Yeah. No, you can buy. Well, I think that's what we're talking about here. Treasury notes are lending the government money, right? Okay. Well, he's saying a savings account. Yeah. Well, but lending the government is a similar type of situation. When you're lending money to the government or you're lending money to a savings bank, the money is insured by the government. So either way, it's essentially the same thing. Yeah, most generic f of x is just linear. Then you just care about positive expected value. But I think from this example, it's very obvious that only caring about positive expected value isn't very good in the long run, right? Because that would just say, okay, well, I want the most expected value. I'm just going to bet everything every time. So every time I win, I'm just going to put all my money back on the bet again, and eventually I'm going to lose, right? So that's not a very good way to gamble here. So this is usually your most common utility function. Sometimes if you want to take a little less risk in your portfolio, you'll pick one of these and pick like alpha 1.5 to 2.53, something like that, because this will add a little bit more concavity. These look something like that, and then log looks something like that. But at the end of the day, so our stated goal is going to be not to maximize our expected value, but to maximize the utility of this wealth. And in this particular case, when we were looking at the log of W, the log of the amount of money we have, if we try to maximize that, that's essentially just saying that we're trying to maximize the long-term compounding growth rate. So we're not just trying to get like the highest amount at some point in the future, we're trying to like continually get the highest rate of return. So instead of trying to maximize just our portfolio outright as like we're just trying to get the highest expected value, if instead we want to maximize the log of our wealth, that's a different question, and that requires some sort of intermediate value between, betting everything or just betting nothing, right? Taking no risk or taking like way too much risk. So essentially the problem here that we want to solve is we want to maximize the log of whatever our amount of money is. And there should be some basically like optimal strategy where we just bet some proportion of our money every time, and based on how much we expect to get and how volatile our returns will be, that's going to affect this long-term growth rate. Yeah, log of W is undefined. The wealth is positive though. Wealth is the amount of money, so it's always positive. You can always estimate E of W, right? You can always estimate the expected value in the future. So one way is we can use like Monte Carlo simulations, depending on what the stochastic process is that we're trying to model. But one of the ones that works really well is just Monte Carlo. Basically, you just simulate it a bunch of times, and then you look at the log at the end, and you just take the expected value like you would normally. That's one way to estimate. So yeah, let's see. Let me look at my notes real quick. Okay, so any questions right here? What is a log? Good question. Does anybody need me to go over logarithms a little bit more? So logarithm, this is just the inverse of the exponential function. A couple things we need to know is, it's concave down. It has this negative curvature. And that means that, again, I'll remind you guys that the expected value of the log of W is always less than or equal to the log of the expected value of W. Right, and that's important because, here it's saying that, the thing that we're trying to maximize is actually a smaller quantity, or maybe I'm not saying that properly. But yeah, remember, this is Jensen's inequality. It comes from this concavity here, the fact that these lines always lie below the curve. Yeah, the utility is defined on total wealth. Yeah, so you think of it like a stock portfolio or something. It's just the total value of the portfolio. How much do you value that wealth? Usually you're trying to grow that amount at the highest rate compounded, and so you're trying to maximize the log of that wealth. If you're just trying to maximize the wealth in general, that's usually a bad thing to do, because usually you're betting too much. You're just trying to maximize the expected value, but then the amount of volatility that you're including by doing that is, eventually, like in this case, eventually you're going to lose. Eventually you're going to zero out. So you can't bet too much, because 3/4 of the time you're going to lose all of your money. So yeah, it depends solely on the wealth, since the probabilities are fixed. Exactly. Yeah. If these probabilities changed based on whether I won the tournament or lost, then it would depend on something else possibly. But yeah, Jeff is correct here. Yeah, the amount only depends. So like if we start out, we bet $10 and we hit our 20x, now we have $200 plus the original plus the original amount. So now we have $300. The next amount we would bet would just only depend on that 300, and we would just bet basically the same proportion every time, because if the proportion we bet last time was ideal, it should still be ideal this time. Yeah, I was actually thinking of that example bit earlier today. If you know you're gonna die tomorrow, then why not just bet everything today, right? So that would be like infinitely negative utility of wealth, right? Like I don't even care about the wealth in the future, because I know I'm gonna die tomorrow. So maybe I'll just put all of my money on this one bet, So you can always look at it different ways. It really just depends on how much you're valuing this wealth, and when you get additional wealth, how much do you care about that additional wealth in the same proportion as you cared about the original wealth you had, or is there some sort of negative concavity where the more wealth you get, it's not really adding, you have diminishing returns basically. Like once you have $1 billion, another million on top of that isn't really, doing the same thing as much as like, if you had $100,000 and you found $10,000 on the ground or something, right? So we're trying to find the betting function that maximizes wealth at the nth step. Yeah, I'm not claiming that I'm going to solve this closed form here. Maybe we could do this in the future. I didn't solve this, but you can. I did want to illustrate here that it's clear that it's somewhere between betting zero and betting everything. We don't want to bet everything every time because we're eventually going to lose, and we don't want to bet zero every time because we do have some positive expected value here. So betting nothing seems like we're missing out on some opportunity here, right? So there should be some intermediate value. You could always do Monte Carlo. That will let you estimate what that intermediate value is, but it also depends on what this utility of wealth function is. If it's the log, then I'm pretty sure there is like a closed form solution here, but I didn't do it out, so that might be something fun for somebody else to do out, or we could maybe try to do this next Wednesday or something. But yeah, I really just wanted to take this problem as like an illustration, not really trying to like solve it exactly. Yeah, that's why you have children, exactly. So one other thing I wanted to talk about was something that's very common in like hedge fund talk, financial math type stuff, which is called the Kelly criterion for betting. And this comes up in poker too. The idea is that like if you know what the risk is of the bet, there should be some optimal amount of your portfolio that you should bet. So sort of similar here, but the Kelly criteria is just for a binary event where either you win or you win some odds bet or you lose. So this one's like slightly more complicated, but I wanted to go to the simpler case. Yeah, Jeff, what is that for? Oh, utility of wealth. Yeah, I'm not sure what you're saying there. I actually kind of like the 30-second delay because it gives me a little bit of time to read the chat before I continue, actually. My brain moves a little bit slow, so. Okay. And hopefully if there's any ads or anything, let me know so I can slow down. Maybe we hit an ad already. All right, so yeah, let's look at two different Kelly criterion ideas. So yeah, we'll come back to this problem maybe eventually, but I didn't want to actually like quote unquote solve it, meaning like what is the optimal amount to bet every time. Like I said, you could Monte Carlo it, get some estimate, but maybe in the future we'll actually try to find the exact solution. But let me come back to this a little bit later. Are there any questions? Okay, so let's look at two different ideas of Kelly criterion. So this is like a common betting strategy type thing. I don't know how all these markers die so quick. So let's look at two different forms. So I don't want to explain too much about the geometric model here, but let's just assume that we understand how stock prices move. There's some mean and volatility component to it. So if we have a stock with like instantaneous mean mu and variance mu squared, there's some ideal amount of the portfolio to put on that stock, which is basically, there's a formula mu minus r over sigma squared. And the only reason I'm bringing this up right now and not going into more detail into this, I just want to point out here that, so this is telling you how much is the optimal amount of your portfolio proportionally to put on this stock, and the rest of it you just leave in cash and put in bonds, treasury bills or something. But the important thing here is that the bottom is dividing by the variance. So what that's saying is, if the stock is more volatile, if you have a stock that's, a less volatile stock might look something like that, and a more volatile stock might look something like that. This stock has more volatility. That's saying that the volatility is actually hurting me. It's saying that I can't bet too much money on this thing if it's too volatile, because I'm dividing by the variance here. So yeah, basically it's a tug of war between the stock returning you, giving you a better return, which is good, and then being more volatile is bad. So, yeah, so this is one form of the Kelly criterion. It's one incarnation, or one kind of way to view it. And then the other form would just be for a binary event. So just a single bet. You can either win the bet or you lose the bet. And if you know what your probability of winning the thing is, then there's another formula that's very similar. Well, yeah, then your utility of wealth function bit would, wouldn't allow you to risk anything, right? So you would have a very concave, like infinitely negative concavity, right? You just can't take any risk at all. Oh, sorry, I didn't see the ads thing. Right, I'll slow down a little bit. It's not random into the 19th lesson. All of them are on YouTube, so I've been going in order. It's not random. Have you mentioned log of p? I'm not sure what you mean. Log of p? The only time I know log of p shows up would be in entropy. But yeah, we're not talking about entropy, so. Oh, log of p is in the proof of the Kelly criterion, right? Yeah. Yeah, that will show up, yeah. We're not going to prove it, though. So this is one form. It's saying if you have a stock, it gives you mu gains on average, and it has some variance, some volatility factor here. This is telling you how much you should bet on it, and it's inversely related to the volatility. The more volatile it is, the less you want to bet, and the higher the return, the more you want to bet. Another form is, very simple case, either you win the bet or lose the bet. Some 1x bet. Whoa. And your probability of winning, probability of success is p, which of course is, between 1 and 0. Then it says, then the optimal amount you should bet is just 2p minus 1. Or there's a more general formula where if the odds are different, like you win beta 1 odds, then there's another formula, which is, I'll just write it here. It's like b times p minus q over b. But here just b is equal to 1. Because we're winning 1-to-1 odds, basically. Right. Good question. Yeah, what is R? Right. Yeah, what is R, guys? I forgot to mention that. So R is the quote unquote risk free rate. So that's the rate that you would get on your treasury bonds or whatever you're viewing as like a basically like an instantaneous no risk investment. So usually that would be like the overnight rate at the Fed or something, right? A lot of the times you can just assume R is zero just to make things simpler. So a lot of the times, yeah, R equals zero just will make things simpler. I just wrote in R just in case. If you view this without the R, then it's just like mu divided by uh, sigma squared, and then it's just essentially just a ratio between those two. So you're just, you want mu to be higher and you want sigma to be lower, essentially, as low as possible and mu as high as possible. Mu is the average price gain, but it's in like an instantaneous sense. So that's why I didn't really want to have to try to explain it. But there's this continuous process that's similar to that binomial geometric process I was going over last time. And so mu is sort of like your instantaneous rate of return, and sigma is like your instantaneous rate of volatility. So it's dependent on the time scale. But it's if you go really, really, really to a really small time scale, then mu is your average rate of return, and sigma is your average standard deviation of those returns. R is like the opportunity. Yeah, R is sort of like an opportunity cost. Yeah, because all of the money that goes into the stock is not going into your risk-free asset, right? So we basically have to assume that mu is greater than R, because if I'm not making as much money as putting my money in treasuries and taking no risk, then basically I shouldn't be putting money in that stock at all, right? Because if the stock's only making me 1% per year, but I can just put all my money in treasuries and make 5% a year, then obviously this is going to be negative. That's just saying don't invest in this stock, right? There's no point. You're not making enough return to justify it. You're not even making as much as R, right? Which is the no risk investment. Okay. Yeah, so two ways of viewing it. You either have this like instantaneous picture, which we haven't really discussed too much, but in that model, this tells you how much of your portfolio you should be betting on this stock at any given time, and the rest of the money you just put in some safe investment that gets you this R return. In a similar type of case, but not continuous, here is just the event. You have a single thing you're betting on. So yeah, this is like the thing you would use for. You would think of this in terms of like sports betting or, I don't know, any type of binary contract or binary event that you're betting on. If you know the exact probability of that thing happening, which you usually don't in real life, but if you did, then this is telling you this is the exact formula of the proportion of your wealth that you should bet each time. So you think of if you have a 50-50 event, like let's say we go to a perfect casino where all the odds are perfectly 50-50, then this is saying that we shouldn't play any of those games, because if P is 50%, then 2 times 50% is 1, 1 minus 1 is 0. This is just saying if you're playing even games, why play them at all, right? Because in the long run, expected value is all going to cancel out. This is just saying just don't bet any money at all. You don't have any positive expected value, so why bet? And then any higher value of P, once you get to like 75%, now your 2 times 75% is 150, minus 100 is 50%. So once you get to an event that has probability 75% chance of happening and it's paying out 1-to-1 odds, then this is saying you should put half of your money on that each time. So it's not quite good enough to put all of your money. The only time you're going to put all of your money is obviously when P is 100%. You're only going to put all of your money on a bet when it's 100% that it's going to happen. No other possibility is possible. All right, let me catch up on the chat a little bit. It'd be the treasury yield curve. Yeah, treasury yield curve. So we're assuming here this is like the instantaneous treasury return. So this would be like a treasury return of, epsilon time, right? Yeah, Merton added the R part. That sounds right. I'm not sure if that's true, but that sounds right. Um, or rather, minus R. What is the asterisk? Which asterisk? Oh, I don't. I'm not sure why they put the asterisk here. That's a good question. I'm just copying it from stuff I was reading. I'm not sure why they had it either. Honestly, I was thinking about that too. Does Black-Scholes assume mu equals R, meaning you should never invest? That's a very good question. No, that's not true. So I probably don't want to say too much in that. I'll definitely get to Black-Scholes, but we haven't really talked about continuous anything yet, so I don't want to talk too much about it. But in Black-Scholes, you're actually assuming that the stock gives you the risk-free rate of return. So it's not. You actually have to perform something called a change of measure between the two stochastic processes. Um, so originally the stock could have any mean, but to calculate Black-Scholes, you're actually just going to assume that mu equals R. Because remember, in Black-Scholes, you're doing delta hedging, so you're never taking any risk. So essentially, the F star there is just zero. So you kind of are just betting zero. Because when you're delta hedging to dynamically hedge for Black-Scholes, you're not taking any risk. So you should be getting the risk-free return, essentially. So yeah, we'll get to that. I don't want to confuse you guys too much about Black-Scholes before we've really said. So we're gonna start on Shreve next week, probably. I think on Tuesday. And the Shreve book, which I put in the resources, that's like a binomial process simplification of Black-Scholes. So instead of a continuous stock, you just have a stock that's trading at like time 0, then time 1, then time 2. And it can either go up or down by some small amount each time. So yeah, we're going to start with basically like a simplified Black-Scholes model, and then we'll eventually get to Black-Scholes. But I actually think the simplified model is probably, not only is it just as useful as Black-Scholes, but I think it's conceptually it makes a lot more sense than Black-Scholes. Because Black-Scholes, you need to do a lot of like continuous stochastic math, and there's some sort of, you have to actually prove that the formula gives you what you want, which is not obvious, I think. So, what do you mean by non-directional? Oh, yeah, it's non-directional in the sense that, yeah, you're not taking a position, right? Yeah, you're delta hedging all the risk away. Yeah, yeah, it's non-directional. Yeah, because remember when you're trying to price the option, when the option has some sort of value, what you're saying is that what would someone that's taking no risk and doesn't care if it goes up or down, what would they value the option at? And that's someone that's basically not taking any risk. They're expecting the portfolio to just give you a return of R each interval. And because you're not taking any risk, then you're not expecting to make any money either. You're just expecting to make that risk-free rate because there's no risk. Yeah. No risk, quote unquote. But you would have to trade continuously, yeah, like literally every nanosecond, or even faster technically, to actually make that formula true. So Black-Scholes is really just an estimate because we can't trade every moment. I don't want to get too much into Black-Scholes though because I haven't even written down the formula, so it's probably a little bit too early. Right. So there's two forms of Kelly criterion. Essentially, the idea is how much risk am I taking? How much do I expect to make? And if I know those two things, then I can figure out how much to bet optimally. So if something is a sure bet, it means P equals 1. Yeah, that's correct. If something's a sure bet and P equals 1, and I'm getting paid 1-to-1 odds, then I should just put all of my money on that bet. 2 times 1 minus 1 is 1. So I should put a proportion of 1. Because obviously if I'm always going to win, why not just put everything on it, right? If I know I'm going to win for sure, then the optimal thing is to just bet everything. Okay. Right. Yeah, let me just draw a couple more pictures because I actually think the pictures are very illustrative. Oh yeah, and then we'll talk about options for a second. Yeah, let's look at like two hypothetical scenarios. I'll just draw them out. So let's say there's a stock here. Its instantaneous rate of return is, let's just say 10. I don't know what I forget the units. Maybe the units will matter. No, I don't know. Let's just say it's 1, just to make things simpler. And let's say sigma is also 1. Maybe it's 1%. Yeah, here it actually matters. Yeah, let's pick something reasonable. So, these are like percentages, and I guess the time period matters too. So let's say, oh wait, no, it's instantaneous type result. So, yeah, let's just say this is 0.1. But I think even though it's instantaneous, it has some sort of units. So I need to think about this a little bit more. But, yeah, instantaneous shouldn't have units then. It doesn't really make sense to say like instantaneous yearly volatility. Okay, I need to think about this a little more, but let's assume, yeah, I guess it's kind of silly without having the precise numbers, but okay, forget about the numbers for a second, but we have some stock with positive expected value and some, non-zero volatility. Actually, you know what would be interesting? Yeah, actually, let me pick something interesting. Let's say that mu and sigma squared are actually. Oh no, that doesn't work. Okay, I'm sorry. I really just want to draw the picture. I guess the numbers aren't really that important. So let's look at, or I don't even want to say bad, but like underinvestment. Just right. And too much. Can you prove the Kelly criterion for the 1-by-1 case? Yeah, I usually do with logs. I probably can. I didn't look at the proof right before I have looked at the proof before, and I know what you're talking about with the logs. Like, you have to. I would have to think about it for a second, but I remember. I know what you're talking about. Essentially, it should be some sort of. I can't remember how to prove it. I'm sure if I sat at the board long enough, I would remember how. Yeah, so what are we trying to prove? So yeah, we want the Kelly criterion. Yeah, so we're trying to show that the long-term compounded growth rate is maximized when we pick that 2p minus 1 value. So yeah, I think you need to take logs, and then you need to take a derivative somewhere, and then you're maximizing it. So it's a calculus problem. You just want to solve the derivative equal to 0, and then you show that the solution is 2p minus 1. I think that's how you do it, but I can't remember. If you know off the top of your head, or you look it up on ChatGPT or something, let me know if that's what I said makes any sense. It's like log value increases by 0.01 per day or 0.25 per day per year or something. Yeah, exactly. Yeah, it's like the rate of the log per day or per whatever unit of measure you're picking. Yeah, so it shouldn't depend on the measure though, because yeah, mu over sigma squared should just be whatever it is. It shouldn't depend on the time period you're picking, but yeah. Okay, let me just draw these graphs real quick. So if you have a stock, it's yielding you something positive, but you're basically not applying enough proportion, like what we were just writing down. You're gonna get some return that looks like essentially you're just getting the risk-free rate. Maybe it has like a tiny bit of risk, but it's essentially just going up at compounded rate of R per whatever per year or something. Right? And it doesn't really vary from this exponential curve very much. Or we could be taking just the right amount of risk, and then we have a little bit more volatility, but our portfolio is growing a lot faster. And then maybe if we bet too much here in the other extreme, then our volatility is so high that we end up losing everything and we go to zero because we just put way too much on this stock. The stock was too volatile for how much returns it was giving us. And we ended up like huge swings, and then we just lost all our money at some point because the volatility was so high. So this is like the general framework here. If you're not investing too much for the return, you're just going to end up getting that risk-free return essentially, and not much variability. If you're putting that optimal amount on that stock based on the risk and the return values, you should get the highest compounding growth rate that's possible based on the, that abstract model, of course. And if you're betting too much, you might get some high swings at the beginning, but eventually you're taking too much risk. The portfolio is going to crash down so much that it's not going to be able to recover because essentially you just took too high of a risk and it went bad. Right. Yeah, so I mean, a lot of people's portfolios, you'll see, like, they look like this. Like, they're doing really well for the first year or two, but they took too much risk. They had a really bad year or a really bad month or something, lost half their money or 3/4 of their money or something, and then, they don't have enough return on average to recover. Once they have some giant downswing, they just, can't recover from that. Volatility equals profit if volatility is not profit. Like, you don't want volatility. You want returns and not taking any risk, essentially. But usually to get a higher return, you need to take more risk. So there's always this balance here. Black-Scholes doesn't allow losing everything. Yeah, that's true. Technically, you can't lose everything. You can you can just get negative infinity log returns, I guess. But yeah, you can't negative infinity is not a number, right? So you can't take log of 0. You might swing into a huge gain, but then you'd have to dump it before you swung back. Yeah. Why would you even invest in the volatile? Wait, where was this? Why would you invest in the volatile stock? Well, yeah, I mean, you're going to invest in a volatile stock if it's getting you a high return, right? So I don't know, pick your favorite volatile stock on the market. Like, let's say Apple has some volatility to it, right? It's not like the most volatile stock, but Apple has like very good returns, right? I think it's doubled in the last like 5 years or something, or 5 or 6 years. So, it goes up very fast, but you might lose 10 or 20% in a year. Like, you can't really guarantee that you're going to get that high return rate every year. So, yeah, and usually the things that are yielding you an even higher return than, say, Apple, like maybe a Tesla has done really well in the last 10 years or something. But Tesla can drop like 70% in a year, right? So you can't bet too much on Tesla, even though it does really well in the long run so far. It's so volatile that you can't put 50% of your portfolio in Tesla or 100% of your portfolio in Tesla, because it could drop 70% in a year, and depending on who you are, that's probably not good, right? You don't want to lose 70% of your money in 1 year, right? So wait, what are we arguing about here? If you're watching, yeah, if you're watching yeah, of course I'm not. This is all we're assuming the stock price movements are completely random, which is a big assumption here. So like, there's no information essentially from the stock price movements or from the company that's going to change the model. This is a very, very uh, bad assumption, I guess you could say. Not bad, but it's very, we're not assuming many things, I guess you could say. Um, what did I miss here? Anything? Those are factored into the price. Time latency before that happens. Is it possible to calculate the volatility of a stock? If so, calculate it and wait when it's time to buy, since we're expecting the volatility to still persist. Well, according to this type of model that we're going to be running here, there's nothing about the price that tells you about any information about what's about to happen. So it doesn't really matter what the stock does. It can go up, go down. It can do nothing for days. It doesn't get, theoretically, according to these models, it shouldn't give you any information about what it's about to do. So it could have went up 1,000x today, but you can see if you look in the silver market today, that's probably not true because you guys, silver just dropped like 30%, I think, in the middle of the day. So that's not a common move, and it's because it's been going up so much the previous days. But theoretically, we're supposed to assume that whatever a stock or commodity did the day before shouldn't affect today. But that's usually not true in general. It's not strictly true, but assuming it allows the model to be simple enough that makes a lot of things easy to calculate, essentially. Oh, okay. Sorry. Yeah. I'm trying to catch up with all these chats. Everyone's so interested in this topic. Okay, so is there anything... Yeah, I want to talk about options a little bit before we finish up for today. I guess I won't say too much. I just kind of want to give you an intro into the notion of them, so when I talk about them next time, it won't be out of, like, nowhere. So I guess the first time you see the notion of an option, it essentially just seems like completely just for gambling. And for some people, it probably is just a gambling device in some sense. But there is like a mathematical sort of reasoning and financial engineering ideas behind like why options should exist or why they do exist in a market. But the idea is, so for an option, it has some expiration date, which sometimes I'll write as some time to expiry, TTE, and has some strike price, and usually we'll write that as K or K dollars. And the idea is that, so for a call option gives the owner of the option the option to buy, usually it's 100 shares, gives the owner the option to buy 100 shares of the stock at a price of K dollars per share. Yeah, exactly. Covered calls aren't gambling. Yeah, exactly. Yeah. When you're selling the calls, you're playing like you're the casino essentially. So you're you're taking the risk off of your stock because you're basically letting someone else gamble with your stock. You're selling the option to them. You're taking off some of the risk because if the stock goes down, you get to keep the premium from the option. So yeah, covered calls, not so much gambling. You could think of a covered call as more of like a bond payoff. So it's actually more like you're lending out money into the market instead of just buying the stock outright. Bit. You're happy. I'm happy you understand it. Yeah, it's Stooky. Yeah, right after we talked about silver this morning, it dumped 30%. I know. It was insane. Right, yeah, European or American? Yeah, that's a good question. Yeah, so these usually we'll just study European options because it's simpler. American, of course, Americans have to be different, right? Because we're Americans, right? No, but yeah, the American options are just way more annoying to price because there's this constant thing where you can exercise the option at any point. Oh, right. That's a good point. Right. I guess I should make that more clear in what I wrote here. Yeah. So call option gives the owner the option to buy 100 shares of the stock at K dollars per share at the TTE or at the expiry date. So that will make it a European option. The American options, you can execute them at any point before the TTE, before the expiry date. But the problem with the American options is it's really annoying if you can execute it at any point. It makes the calculation of the price. In fact, I think there's just no closed form solution. You have to essentially model it like I was saying before with the Monte Carlo stuff, or you can do it with this binomial options pricing, which is the Shreve book, which we'll get into soon. Okay, the ads are there. Yeah, I'll slow down for a second. I actually don't know how black-scholes look at them differently. What do you mean by that, Jeff? Risk management seems like it have a lot of analogous applications. Yeah, so that's actually another. I'm not sure if this is what you meant by your comment a bit, but I think the thing I want to stress here is that these things don't have to be money. I mean, it's easy to think about it if it's just stocks and money, but you could really think of this as like a risk formula for any type of quantity where it's uncertain what the value of the quantity will be in the future. How much of my resources should I allocate towards that risky endeavor, knowing that it might pay me some reward or it could pay me, negatively. So you could think of, we have to allocate energy in our bodies to different parts of the body, right? Like, I'm not going to allocate energy to a part of my body that's dying because that's not going to yield me a high return. The part of my body is dying. I should just allocate my energy towards, something that's going to return me some productive use or something. But you could probably, maybe you guys in chat can think of something else where, you have some quantity. It's varying through time, going up and down perhaps, and you need to base some decision on the riskiness of that or whether that thing's going to yield you some sort of productive return or something, right? So it doesn't have to be money, but I think money does make it a little bit, almost simplifies things because money is almost like just raw numbers. There's no real like physical tangible component to it, right? You're just trading literally some number up and down. The volatility of volatility, yes, yeah. Is there a risk of risk? Like, let's say if you think there's a 60% chance of risk having a positive curvature over time and a 40% chance of the opposite. I'm not 100% sure what you mean there, but I think I get what you're trying to say. And I think Jeff is sort of answering you there. So there's futures on the VIX. There's a VIX of the VIX in the CME futures. So there is some way to gamble or hedge your risk, essentially, depending on your viewpoint. So when the market has like a big downturn, the VIX will go up very high. So a lot of traders they'll sell futures on the VIX or buy futures on the VIX to hedge their portfolio. Because if their portfolio is going to go down very fast, they might have a lot of leverage and buy a bunch of VIX futures, and then the VIX futures shoot up. They make a bunch of money to offset all the money they lost on their other portfolio, or somewhat offset it, right? So the key here is whenever you lose a lot of money in one of your investments, you want the other investment to be negatively correlated, right? So if you lose a bunch of money in the stock market, you want a bunch of VIX futures that are going to go up at the same time so that Your overall volatility is lower. Yeah, VIX mentioned. check that off. I'm thinking of like in physics with velocity, acceleration, snap, crackle, pop. Are these the higher derivatives of position? I know there's one called like jolt. I think that's like the fourth derivative. I don't know. Is this sort of a kernel of quantitative analysis? What do you mean by that? Gambling on gambling, yeah. No, I mean, it is a lot of gambling on gambling, but like I said, gambling is just you're taking some sort of risk with some expected return, right? And you need to size, is this too much risk to take for this amount of return? Should I not bet at all on this thing? And if it is a thing that you think will return you money, how much of the amount of money I already have should I risk on that thing, knowing that it might not yield you money. It could go down as well. So, I mean, yeah, if you think of it like that, all financial markets are essentially gambling because one party is trading some amount of money for essentially some stock ticker, which is essentially nothing, right? It's just a claim on some rights to a company. And that the value of that can fluctuate in time, right? So you're not necessarily going to get the same amount of money back that you put into it. So you have to gauge whether that risk is appropriate for the amount of money you have and the amount of value the amount of utility you get from the money that you have, and the amount of utility that you would get from the money that you would get from the profit as well. Yeah, it's sort of like elementary quantitative analysis. Yeah, you could think of it like that. Yeah, I mean, yeah. Yeah, I'm trying to make it simpler. I mean, the Shreve book is actually pretty simple, but I'm trying to give you kind of like a overview to make it even, like, give you more of a probability foundation for this stuff as well. You can go into gambling on gambling on gambling on gambling. Yeah, but at some point, we'll actually show, probably at some point I'll maybe even prove it, that when you buy these options, it's essentially equivalent to taking out leverage. So if you buy an option that's sort of simulating 10x leverage, it's kind of like I just went out to a bank and said, I have $1 million, give me another 10 million, and I'm going to put it all on this stock because I know it's going to go up, for instance. Maybe I'm insider trading or something, right? So I know this stock is going to go up for sure. Give me $10 million, bank, and I'm going to put it on this stock, and once the stock goes up, I'll take my profit and I'll give you your 10 million back, right? So that's like a common thing. Yeah, but gambling on gambling on gambling, yeah. So I mean, these options, they just give you, I mean, like Jeff was saying, if you're the seller of the option, you're taking the other side of that. So the buyer of the option is looking for some sort of convex payout from this stock price, but the seller of the option is the other way. They're looking for a concave payout. They're looking like for some sort of bond like return where they're just essentially lending out their money to the market, and they expect when they reverse the trade that they'll make some small reasonable profit, but nothing like crazy usually. You're just getting usually nothing more than 1x for sure. Yeah, you can't buy calls on margin for sure, because the calls themselves are already kind of like leverage. So, but the thing about the calls is there's leverage, but you can't get margin called on the options. So that's actually a good thing. So they behave like leverage, but leverage where you can't get margin called, which, depending on what you're doing, could be very useful. The seller believes the return less than R. Buyer believes greater than R. Well, yeah, if they thought the return was less than R in general, then they probably just wouldn't buy the stock or the options at all, right? They might even take a negative position, right? Like where they're buying puts or selling short, something like that. Yeah, it's like selling lottery tickets. Yeah, it's like I think of it like you're playing the casino. Like someone else is looking to gamble on the stock, and you're not really taking a position one way or the other. You're sort of somewhat neutral. You sell the option, you get some sort of premium back, but you're not really, yeah, you don't really care if it goes up or down. In fact, usually it's better if the stock just doesn't go anywhere. It just kind of goes up, goes back down, goes back up, goes back down. Then if you sell a covered call, you're making money in the long run. So yeah, a lot of people, I wouldn't recommend it. This is not financial advice, but a lot of people will just buy very stable stocks, Microsoft, stuff like that, Tesla, stuff like that. Buy the stock, sell the, well, Tesla's maybe not so safe. I shouldn't say that one. But they just buy the stock, sell the covered calls, and they're not taking very much risk, but they're getting almost, depending on what the strike price is, it's an almost surely that you're going to profit in the end. But there's some risk to that as well. The stock can go to zero, then you lose everything, so that's not good. So you have to be careful. You have to know what you're doing if you do that as well. Delta neutral position, or it's just like closer to neutral, right? Like selling the covered call could lower the delta a lot, so you're just taking a lot less risk. Maybe you still have some risk, but you're moving the risk to like a different part of the risk curve. So you're getting some constant return, but you're risking the fact that like the stock could just go to zero. You have this very skewed return. Everything could just go to zero all at once, right? So Trump coin, yeah, exactly, Mouse. All right, yeah. So we'll talk more about options next time. But the thing that I want to point out, which goes along with what we've been talking about, is so you have this payout curve. So here's the strike price K. And the important part about this curve is that it's concave up. This is a convex type return. And that means if we look at the price based on the price of the stock, so the bottom here is the price of the stock S, and this is the price of the option. So you can see if you buy a call option, the higher the stock goes, the option is going to go up in value. But if the stock goes down to zero, or maybe I'm drawing this wrong. Or I guess it's not really the price. I guess it's the price of the option minus K, really. Because right here the option should be zero, worth zero. But yeah, you can see even if the stock price goes to zero, the option isn't even necessarily going immediately to zero, because there's still some chance that the stock price will increase again and the option will be worth something again in the future. So the point here is that this concavity here is has very similar behavior to a lot of the other stuff we were talking about, like with Jensen's inequality here. And this concavity is you're changing the concavity of the stock return payout, and that in turn skews that expected value, and so you get a different. So you notice that this dotted line is raised above this. That's saying that there's some premium value to the time value to the option. The fact that this payoff is convex means that there's like a lot of, you could think of it in physics. In some sense, the option has like a lot of potential energy, because if the stock does end up getting a very high stock price, this thing could potentially be worth a lot. So in some sense, it has like some potential energy, and there's some premium value to that possibility that it could explode. Plus, if you get called, you have to repurchase at some point. Yeah, that's another risk, of course. Yeah, you have to repurchase at some point, and you don't know what price you're going to get. You might have to repurchase once the stock market opens the next week, and the stock could be 50% higher. So that's a huge risk as well. Now you just can't buy it again. The stock market wasn't open, so you're out of luck. What is do butterflies? Oh, butterfly. The options strategy butterfly. Yeah. No, we're not talking about that yet. Rex is my stock pouch. It only goes to zero. No. If the stock goes to zero, well, yeah, okay. If it goes to zero and they're bankrupt, yeah, then I guess the volatility goes to zero as well, right? Because it's at zero and it's not moving from zero. So then I guess your premium would also go to zero. But yeah, even if the price got really close to zero, for instance, but it wasn't actually zero there, and it still has some volatility, like people are still trading it technically, then there is always some chance it could get back up. So there should be some non-zero premium to that. Um, yeah, we've been going into probability mouse. Just very basic probability. We've been doing like expected value. Uh, we have some random variable that has a state space of things that could happen with different probabilities. It's just some discrete space. The probabilities all add up to one, and you think of like rolling a die. There's 6 possibilities, 6 different values, and that's what we think of with random variables. And now we've just been talking about stocks and different things that can vary randomly, different random processes. Yeah. All right. I think that's it for today. Unless other people have questions for me, we will have the 24-hour stream tomorrow. I'll be doing a little bit of research. Hopefully, people that are interested in the research will show up. So we're talking about operads. This sort of non-commutativity, but commutativity up to homotopy. And we have a couple different operads we're looking at, and a problem we're trying to solve, which is this graph homology problem. Right? That should be it, I think. All right, I'll try to raid. Let's see if anyone is on that wants to be raided.